Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today we're going to start talking about an entire series of videos that we want to show, all about bonds. Bonds are a really interesting investment. We believe that everybody should have bonds, and we feel that we really need to explain from the very beginning why people should have bonds. What are bonds? What types of bonds? All those types of things. You know, Steve, one of the things that I didn't tell you about, yesterday I got a call from a reporter who was asking me, specifically his question was, are bonds dead? Is the 60-40 portfolio dead? And we all know, hopefully you watched our video where we talked about the problems around a 60-40 portfolio and why 60-40 isn't the right answer. I mean, he was asking me all these questions that seems like just a whole bunch of fallacies and misunderstandings around what diversification means and why you should even hold bonds. And so it was very, very interesting.
Well, what's funny about that is, older people may recall, I believe it was in the 1970s, might have been on the front of Newsweek or Time magazine, and they had a front cover or a front page that said, our equity's dead, because the stock market really hadn't shown any real appreciation, probably 10, 12 years. And so we see this time and time again from journalists, and I guess also from advisors, and even from people, consumers, who don't fully understand the way the markets work and the way different investments work. And so they'll come up with some sort of statement like that, or they'll say that modern portfolio theory doesn't work, just because they have this bias, which we call recency bias. They sort of look what's happened in a recent past and believe that's what the future is going to look like.
Yes, I mean, well, let's face it, though, really, Steve. The 10-year bond, I don't know what it's trading at right now. The yield is somewhere under 1. I know that.
Well, the 10-year Treasury, last I looked, was around 1.7, and that's up a lot. That's up a lot from, I think, a year ago, might have been around 0.8, 0.8 or 0.9, which was an unprecedented low yield. So it is up significantly. The yield curve has changed a lot, but the short end of the yield curve is still, interest rates are very low. I mean, we recently bought a Treasury bill for a client, and the 1-month yield was basically 0, and the 3-month yield was around 0.15%. It was almost a negative trade. So on the short end of the curve, it's very low.
Yeah, and I think what people have trouble dealing with is the fact that, like, back in the beginning, in the early 80s, yields were somewhere around 15, 16% on a 10-year. So
it would have been a great investment would have been to buy the 30-year Treasury in 1980. I think the annualized return would have been 9 or 10 or maybe 12%. I can go back and check, but you would have probably had a better return than on the stock market. Believe it or not, those days are long past.
Who knew? Which is so interesting, because that's what we see is we see this, everything that was good in the past is not necessarily good now. There's always these different cycles, and that's why we want to be very, very careful before we take an entire asset class and dump it.
That's correct.
So what we want to just talk about, I think, in this video is we want to back up and just make sure that everybody's on the same page in understanding what bonds really are. And then we just want to talk a little bit about the role of bonds in your portfolio. That sound good?
Yep.
Okay. So
I'm speaking for the audience.
Okay. So on the next page, we just have a statement of exactly what a bond contract is. Basically, it's just a fixed income instrument, which represents a loan between you as the investor and an organization who is the borrower. It could be a corporation, it could be a government, and we're going to get to all the types of people that can borrow money, but it's essentially an IOU between the lender and you as the borrower.
Sort of like you're the bank. You're giving the borrower the money, the person buying the house. In this case, it's a corporation. It's buying some capital item, or trying to raise money to invest in their company. And guess what? You're the individual or the lender. You're the bank in this case.
And so, Steve, this is a build slide. So if you hit,
Yep.
yes, it just talks about, okay, this actually skips the last, never mind. We have a slide
Okay.
glitch here. I just wanted to say, so again, there are two parties. There's the investor and then there's company.
Here.
The big important thing to remember about this contractual agreement is that it is a contractual agreement between the borrower and the investor. And so
It is a legal agreement in effect.
right, there's a guarantee. And that's really, really important to understand in this kind of asset class, that you have a guarantee as long as the entity remains solvent.
Yeah, and I want to add a caveat to that guarantee that we're going to probably cover that guarantee in more detail in future videos. And it may not be as safe a guarantee as one would think, but it is somewhat of a guarantee. Yes.
Yeah, everybody has a different definition of what a guarantee is, right, Steve?
Yeah.
We won't even talk about insurance companies and all that.
No.
Because that's a whole nother story. But yes, so you need to understand the risks to that guarantee. But suffice it to say, it is a guarantee, it's a contractual agreement, and as long as everything remains in place, you're going to get not just the money back, but you're also going to get interest. And so that's where we get into this three components of bond. The first component is the amount of money that you're going to expect to get back. And in bond terms, we call that either the par value, some people call it the face value. Whenever they say the par value or the face value, that's the amount of money that you're going to expect to get back at the time the contract ends. So there's a maturity date on that contract.
And I want to mention that the $1,000, you could buy blocks of that. You could buy 20 of those or 30 of those in $1,000 chunks. But also I want to mention a lot of times you might see a bond quoted not in terms of $1,000. Typically they lop off the last zero, and you'll see it quoted in terms of $100 in most places, by the way. So there could be a little confusion centered around that, but that's typically how they're quoted. But they really mean $1,000.
Yeah, $1,000 is a typical lot size.
Yep.
And yeah, there's more complexities to buy, but right now let's just know that you're going to get that $1,000 at the end of the period. But during the period, unless it's a zero coupon bond, which is another kind of bond that we'll talk about at another time, the standard bonds, most bonds, do provide interest along the way. And usually it is every 6 months that they pay the interest. So for example, if it's a 5-year bond, you'll get 10 payments of interest along the way. So you get the 10 payments, and then at the very end, you get that $1,000 back.
Now, typically they call it the coupon, and there's a reason for that, because historically with bonds, a lot of bonds, you actually, when you bought the bond, you physically got a piece of paper, and it had attached to this whole sheet of what looked like stamps, and those were the coupons, and you would actually clip those coupons and bring them to a bank, and the bank would recognize what that was and would actually pay you in cash. So they typically still call that payment on the bond a coupon.
And one thing while we're talking about this, Steve, that I think we should mention is that this coupon that you're getting, when you get that income, it does get taxed as ordinary income tax. We want you to know that. It's not a capital gains, it's not a dividend, it's ordinary income. And so that has implications too in terms of where you hold the bond, which is a whole nother thing.
And of course, there are tax-free bonds, which we'll be talking about in the future videos as well. So not all of them are taxable.
And so the third question that was on there actually was the coupon rate.
Oh, okay, no, I'm sorry. Actually, that's going to be the next topic.
The third question was the rate that, so we have the $1,000 that you're getting back. We have the overall length of time, the maturity time, and then we have the rate that you're paying. And that's when Steve and I were talking about how the 10-year is currently giving you an interest rate of 1.18 or whatever it's giving right now. That is the rate that the issuer has guaranteed you that they'll pay. And so they decide this at the beginning of this contractual agreement. And next year, if the rates go up or down, it doesn't matter. They're obligated only to pay the rate that's on the contract.
Yep.
And so it's important to recognize that when we start talking about the valuation of bonds.
And we're going to be spending a lot of time on that because the valuing bonds can actually be somewhat more complex than one would think. So it's certainly, there are a lot of issues surrounding the valuation of bonds. So I guess the next topic really is, why would you hold bonds in your portfolio, right, Laura?
Especially when the interest rates are crummy, Steve. Why hold them? Why are you not going to, why, if the yield is not good, why would you not say forget about it?
Yep. Well, so, our view has always been this, especially with people who need money from their portfolio. We really believe in the 3-bucket theory. First is that you should keep probably 6 to 8 months worth of your spending need in cash, something very liquid. And the second bucket should be something that you could readily liquidate even in the worst of times and the worst market circumstance. And that would really be bonds. Even though they pay low yield, there really is no other way to at least earn something in as safe a fashion as a bond. And so we believe that the bonds you hold should also be relatively immune to market fluctuations. So there is a very, very important reason to hold bonds in your portfolio. I'm sure Laura can add on to that, what I just said.
Well, just to kind of systematically go through the items, the first is, and we've talked about those 3 buckets before. If you remember, we showed you 3 buckets and we said, okay, you have money in this bucket that's long-term and you're shooting for yield and it's going to be volatile and you're not going to worry about it because you know that's for yourself 10 years down the road or whenever, but you also have money in shorter term buckets that are available to you. And so one thing is that it does create a pool of money that you have access to at any point in time, because we don't want to be pulling money out of those buckets for the long term. When the market's down, that's never a good thing because you're locking in those losses. So the pool of money is really, really important. The second thing, though, too, that we want to talk about is the fact that bonds don't have the same pattern of behavior as stocks. They actually move in different ways. They zig when stocks zag, as they say. And
hopefully. But there are some that zig when stocks zig, and we'll be talking about that in future videos.
Right. So what we're looking at doing is smoothing out volatility, and bonds really help do that because they're negatively correlated with stocks. Some bonds are more negatively correlated with stocks than others, and we're going to discuss that also. But right now, suffice it to say, all bonds are still, will give you some diversification effect and create more efficiency in your portfolio.
That's correct.
There's a third thing too. Yeah, even though, Steve, I'm sorry, 10-year you said was 1.18 or?
1.7.
1.7. Oh, 1.7, that's great.
Yeah.
So 1.7, almost 2. All right. It doesn't sound so great, but the compounding effect of 1.7 over time still is much better than taking your money and putting under the mattress. I've heard a lot of people say tactically that they've chosen, you know what, bonds aren't giving enough return, I'll just keep it all in cash. That's not a good idea because you're still giving up the compounded effect of this return that still can add benefit to your portfolio. So, it still has a great opportunity to give you some return.
That's correct. And so something I will also be talking about in future videos will be the potential for purchasing power loss if inflation heats up. And that is a serious concern with bonds, but it's something we'll be talking about in the future.
Right. So if we show that slide of some of the topics from the future, you'll see that we're really just introducing you to the concept of investing in bonds and why you should pay attention, and you shouldn't just completely abandon the strategy of having bonds in your portfolio. They have a role. Um, we're going to be following up with the types of bonds you should hold, the types of bonds you should not hold. We're going to talk about the unique value of municipal bonds, and we're going to talk about risks in individual bonds, and then risk in bond funds, which is a whole nother way of investing in bonds. We're going to be talking about some other kinds of bonds that we've been using that you might want to consider in your bond portfolio. And then we may even get into some more advanced topics like duration and convexity, which Steve,
Convexity.
you could explain convexity because the average financial advisor has no idea what you're talking about.
Doesn't understand it. And one thing that's not on the list here, which we will also be talking about, is some of the risks people take in trying to find alternatives to bonds and try to invest in other, I would say, income generating investments that really shouldn't be in the portfolios to most people as well.
Right. So know why you have invested in different types of asset classes. Know the role that that asset class plays in your portfolio. We are so happy to have you listen to this video. We're able and ready to explain it to you individually if you'd like. We really want you to understand what you're invested in. The more you understand, the more security, the more confidence you're going to have in your financial future. So thank you for listening to us, and have a great day.